Well, hello and welcome to the Lending Podcast. We got a special one for you today. I think this is going to be our first interview, so let's do some introductions. So this is JB, the guru of mortgage, and I am Jeff Jones, kind of the comedic sidekick, I would say. I'm learning from this
Comic
man.
relief.
And then we got in the house Terry Lee. He is our finance advisor for today, and I'm very excited to have you here.
Thank
So
you, guys.
thanks
I
for coming
appreciate
in.
it. Yeah, I get a lot of questions about what you guys do, and I defer them. So I don't want to do what you guys do. I want you guys to do what you do really well. So
I'm always nervous when you hear about reputations from other people. You never know where it goes.
yeah,
It's true. It's true.
Well, good. Well, why don't you tell us what we're looking at talking about today and why we're doing this?
Well, it's a new year. Happy New Year, 2025. And some of the strategic alliances that we have in our industry, right? We work with a lot of business professionals. We work with CPAs, we work with tax advisors, we work with financial advisors, and a host of other professionals out there. And so really what we want to bring today is insight from our financial advisor to really talk about the market, what you're seeing, and really your approach working with clients as you're helping them achieve their goals. And everyone, there's real two fundamental ways to build wealth, at least what I've been taught, and that is through the stock market, through your investments, 401ks, your liquid investments, right? Your brokerage accounts grow over time, and real estate. Now you can inherit some money. You can invent something and get it patented. You can win the lottery, right? There's other ways to probably accumulate some, maybe hit some Bitcoin. But truthfully, fundamentally, the slow growth of wealth building is through your brokerage accounts, through your 401ks, through your investments, and through real estate. And so, of course, we work with home buyers and homeowners on their real estate needs. And we got Terry in today to talk about the financial side.
Yeah,
Yeah,
no,
what
I
you do.
appreciate it. I mean, so the marriage concept of taking your equity of your home and the net growth that it gives you and the net gains it gives you year over year, plus the equity growth of your brokerage accounts and your other assets that you can invest into. When you marry those two together, that's really kind of your two biggest pieces, what I'm hearing you say, of your net worth. Right?
Absolutely.
The growth of your net worth. And we kind of have that around the table today.
Yeah, and it's important for me, because I really wear a few hats, right? I mean, one is a financial advisor. I want to take a look inside your portfolio, make sure that everything is aligned, right? If you're 20 years old, I don't want you investing in bonds, things like that. And I kind of want to make sure that we diversify, rebalance, do all those kind of boring investment management things. But I think the most value that I can bring to folks is in looking at it from a planning perspective, right? How do your real estate acquisition objectives fit within your overall plan, right? Are we checking off all these other objectives, and how can we diversify all of everything we're doing, that you have in your 401k, that you have in your IRA, your kids' 529, where does real estate fit into that mix? From a few different perspectives, right? Because major tax advantages when you look at real estate, different, obviously the tax side, like I just said, different types of growth patterns as well. And, something we look at a lot too is correlation. I don't always want investments within an investment portfolio moving in the same direction. I want counters, and real estate does a really good job of kind of slowly and steadily moving up, but not really with regard to what's happening in the S&P 500.
Yeah.
Yeah.
I think something that's missed out there, and this is an equation that we actually do with our clients from time to time, is the ability to purchase a home with, let's just say, 5% down payment. Now, there's a lot of down payment options that are zero down, right? We have loans for veterans, 100% financing, USDA loans, 100%. But let's just say on average, we're having a client put 5% down. The leverage that you get in appreciation with purchasing a $500,000 asset for 5% down, you're taking $25,000 and you're getting the appreciation right over time of your $500,000 asset. And it's a different kind of portfolio growth than your $25,000 that I give to my financial advisor that then grows at 8 or 10 or 12 or 15% or whatever over time. So I like the fact that you've got to diversify. You got to have both, I feel like, to really build wealth over time.
Yeah, and the idea of leverage is something that I think a lot of people, and just financial planning as a whole, right? And I mean, jumping on my soapbox real quick, I have a job because we do a terrible job of ever teaching people about what it is that I do, right? You never learn elementary, junior high, high school, college. Even, you go get a great degree in college, but you never take a personal finance 101 class. And one of the things people never talk about is leverage and building wealth on other people's money. Even life insurance, you pay a $60 premium and you've got $1 million death benefit on your head. That's powerful leverage. So leveraging with down payments into real estate or all other areas are things that I think we could do a better job of teaching people.
Yeah, for sure. Well, and I think that there's so much with that financial education piece that we don't learn as high school students or college students, and then we get out in the real world. Now we've got a job and we're making X dollars. And one of the things I think that I know I learned a little too late is not starting early. I mean, talk about the difference of starting to invest at 22 and starting at 42. Yeah. And the guy at 42 is never going to catch the guy that started at 22, right? Because of that compound effect of savings. And we're talking maybe it's $100, $200 a month. I mean, you just have to get going. And I think a lot of folks put off investing because they don't have the money to invest. So just talk about your philosophy on that.
Yeah, because rich people invest. Rich people have stocks. Right. Rich people have bonds. And so it's that paralysis by analysis. There's this inadequacy feeling why people never, so to say, sit at my table. But it's so big, right? And so when people come to y'all's table, right? I mean, there's so many options. That's what's so attractive about you guys, both as operating as the agency and as a broker, is it's like, wow, you guys can really be a one-stop shop. But as soon as I understand everything you guys do, it's so much. And it's the same thing on my end too, all of the different considerations. And so, getting my financial life in order is always a next quarter thing.
Yes.
It's like, oh man, I just got to get through Christmas and then I'm going to do it in the springtime. Well, kids are about to start sports and I'm sure I'm going to slow down in summer, which nobody does. So it's always just a later thing. And then, sure enough, you kind of wake up, mom and dad are really sick. You're becoming empty nesters. You are realizing that one day you'd like to retire, and then you're kind of financially planning from a triage perspective as opposed to being proactive.
Yes.
And I manage that a lot, and that's okay, right? Because by the time that people come to sit down with me, they've got a lot of puzzle pieces, and we just need to kind of make sense of it. And there's some small tweaks that we can make to go a long way. But man, if I can get a hold of working with 22-year-olds, 25-year-olds, I mean, I'll be honest with you, they don't keep the lights on at the Lee House in terms of income.
Right.
But the value that they are giving themselves, $100 a month, right? It's a behavior standpoint.
Yes.
What are they doing by parting ways with 10% of their income? Do they feel it? No, they don't even feel it. But when they log on, holy smokes, I only contributed $1,200 this year. How did that become $1,600? That's really cool. Yep. Well, tack a few more zeros on there, and then it becomes really fascinating, right? And so I enjoy, right? It's a problem solving. Sure. You guys are majorly into that problem solving, and you kind of geek out about the things that you geek out about.
Well, and I think for at least our perspective right now with this market and where interest rates are, it seems like a barrier to a lot of our buyers. I want to wait for rates to come down. Yeah. It's kind of like I'm going to wait to have money to invest. It's like, no, the best time to buy a house was yesterday because it is about time in the market, not timing the market. Mm-hmm. And you can speak to that too from a financial. I mean, you're going to see those ebbs and flows of a portfolio, right? I mean, it might go up 1% today, it might go down 2% tomorrow. But over time, I mean, look at what the Dow has done over the last 15 years. It's unbelievable, right? If you had $1,000 in the stock market 15 years ago, that's probably about $5,000 today, right? It's like 5x.
It's insane.
Yeah, it's insane. And so maybe more than that, but yeah.
If you're trying to, I mean, all people that are doing when they say I'm going to wait, they're just speculating. Yeah. They're speculating just the same way they do on Apple and Tesla and Microsoft and Google and the S&P, and they're speculating on that. But so much of it is just not being willing to move and to change. And I'm sure you guys say this stuff all the time, right? But your rate is temporary. Your rates, let's just get in because high rates present fabulous buying opportunities. And that's what you guys are presented with. But you kind of walk this line, like you don't want to seem salesy or anything like that. You just want to position yourself as the experts. You want to say, buy. Now's the best time to buy. Right. But let's kind of talk about several different factors about why is the right time to buy. And, why the reason I like people to buy as it relates to their financial plan is it's really kind of it's the biggest check mark that they will probably ever do.
Sure.
Right? I mean, getting to retirement is fantastic, but for men, retirement is just kind of switching gears a lot. I don't know about you guys, but I
Right.
want to go like drive the range ball picker upper at the golf course. That's what I want to do. But buying a house, for so many reasons, it's showing that you're able to amass those types of funds. It's not being at the whims of the landlords and the apartment complexes that we were in our early 20s and things like that. So I really need people to check that box off. And then we can start making these significant contributions to all of these other areas.
Yeah.
And that's when we're building wealth.
I like when you touched on the tax advantages, because something that's missed right now in this market is, yes, the interest rates are elevated versus 3 or 4 years ago. However, interest is a tax deduction on your IRS 1040 when you file your returns. And so if you convert that rental payment into a mortgage payment, not only are you building the equity, but you're taking that interest, increasing your deduction, which is reducing your taxable income. Your property taxes are also a tax deduction up to a certain amount, $10,000 a year. And so when you look at those additional deductions, you start contributing to a 401k at a minimum, right? If your employer matches a 401k,
Max it out.
that is the first,
Take the free money.
Take the free money.
It's free money.
If your employer is matching 3%, you should at least be putting in that 3%. Get the employer match and watch that thing compound over time. Now you've got interest deduction. Now you've got tax deductions. Work with your financial advisor to figure out what is that tax refund going to look like.
Right.
But instead of waiting to April to file your taxes, you can adjust your contributions throughout the year. Start getting the money in play, $100 here, $200 there. Over the course of that year, you're increasing that portfolio. You go to file your taxes, and you've invested, and you're still getting a refund that you can maybe pay off some debt with, or put it back into fund your Roth IRA. And I did want to ask you, I wanted you to talk about Roth IRA versus traditional, and just kind of make that distinction for our audience.
Yeah, it's
why
just
it's so important. Yeah,
it's just a matter of tax treatment, right?
Yeah.
It's, are you going to pay taxes now, or are you going to pay taxes then? And we'll kind of use 401ks and IRAs kind of fit within the same bucket. Those are dollars that have never been taxed, right? Even if you make your IRA contributions out of your checking account, you're going back to the IRS at the end of the year and saying, hey, by the way, I made a $7,000 contribution, so take that off my income. So IRA and 401k contributions are made pre-tax, and on down the line, you're going to be taxed at whatever your income rate is when you go to take that out. Now, keep in mind, you can't take it out until you're 59 and a half, right? So you got to let it cook for a while. Roth IRAs, those are made with after-tax dollars, right? And then when you go to take it out after the age of 59 and a half, whatever you need from me, if you need $5,000 from me, I just sell $5,000 worth of investments, and that's what I can send out because there's no tax ramifications. A major difference, especially with longevity kind of coming into the picture more and more, is that IRAs have got, and I'm going to use a lot of words, they've got required minimum distributions, or RMDs, that are attached to them, to where you have to start withdrawing from there at the age of, now it's 73. By the time that we're all there, it might creep up a little bit more, but you're required to take money out of your IRA, pay money to the government, even if you don't need it, even if your income at the time, Social Security at the time, all these other things are taking care of your retirement income, you have to take that. You'd be really surprised how often I take money out of somebody's IRA and just put it right into their non-qualified account because they don't need it, right? But in doing so, they've got to take a 20% hit.
Yeah, some tax liability there.
In doing that. So that's a consideration. And then you got to think about when when my kids inherit IRAs versus Roth IRAs, there's some major tax treatment differential there too, that we want to be mindful of.
Yeah.
So,
and there's ways to plan
massage
for that.
Yep.
Yeah,
Absolutely.
Sure.
Yep.
For sure. There's so, and as you're building this portfolio, right, and you've got your stocks and bonds and your 401k and brokerage account, you're building this nest egg, and you're building equity through real estate. There's some layers of protection that are needed, right? Insurance. And we don't really talk about life insurance too much with our clients, but situationally we should. I mean, I truly believe every single person that has a $500,000 mortgage should probably have that term life policy that covers that in case as a death benefit, just in case something happens, and then all of a sudden, the house can be paid off and spouse can remain there with the family or whatever. So there's a lot of planning that goes in to, it's not just buying a house or sending you a few $1,000s a month to invest. Like there's a lot that goes into
it fits
this.
within a plan, absolutely. And one thing I want to go back to with the IRA and Roth IRA that definitely plays into real estate is how that money grows. Whether those are pre-tax or after-tax contributions, whether you use IRA or Roth IRA, those dollars are not taxed as they grow, right? And so the way that I paint that picture for people is if you have, Ford stock, which I think they pay maybe a 5 or a 7% dividend. If you have Ford stock in a non-retirement account, every time that pays a dividend, it's going to get whittled away a little bit by taxes, right? So what you realize as an investor is ultimately going to be less than what that dividend is. But if you have that same stock or that same investment, whatever it is, inside of a Roth IRA or an IRA, it's not going to be subject to those taxes. There's no headwind that's shearing off gains for you.
So dividend compounds as well, yeah.
No capital gains. It's not going to be taxed. It's the same thing within your real estate as well, right? Now, you and your spouse, you each get a $250,000, you get to avoid that when you go to sell your house with regard to your capital gains. But what does real estate appreciate on an annual basis? Obviously
3 to 5%.
Yeah, changes all over, the country, but that is 3 to 5%. That is tax-free growth. That has got all those cool tax benefits that are working behind the scenes as well, which people never really realize because so many people pay their taxes on TurboTax, just put in the numbers and come on, be green, whatever it is.
Yeah.
But it's a major tool, and what wealthy people do is they play the tax game.
Yeah. Learn how to navigate those tax codes to their benefit, and legally minimize their tax liability. Right? Hopefully, they're doing.
It's called tax avoidance. Tax avoidance and tax evasion are two very different things.
Yes. So you brought up the $250,000 per person tax-free gains on real estate. I love this kind of a fresh topic because I have an associate who actually lives in Tennessee, and he went on social media and talked about this. I thought it was brilliant. So I had to Google this. I'm gonna put you on the spot. It's okay if you don't know this because I didn't know this. I had to look it up. Do you know when the IRS changed and increased it to $250,000? So right now it's $250,000 per $500,000 for a couple. You sell your house, you bought it for $500,000, you sell it for $1 million. Obviously there's some cost basis in there, but rough math, you have $500,000 in tax-free real estate gains, not subject to tax. Do you know when the IRS put that into place? I had to look it up.
I'm sure Jeff knows. No, I have no idea.
If I had to guess, we had an actor in the White House named Reagan.
Well, it was after Reagan, so 1997.
Dang, I was going to say in the
but it blew me away because here we are, 2025. So we're talking 28 years ago.
Okay.
We touched on real estate appreciation. Let's just say 3% per year. Compound 3% per year over 28 years, and that tax-free gains number hasn't changed. I really think that's something the IRS has to look at, and the government has to look at.
Yes. Number, right? Yeah.
It needs to be $1 million. It needs to be $1.5 million, because there are folks right now that I feel like they're probably locked into their homes because they have $1 million in equity. They don't want to sell and be subject to a 20% or 30% tax on $500,000.
I was working with somebody yesterday, and they bought for $600,000. The place is worth $1 million right now, and they're looking to sell. And they said, and they're 65 and single, but dating somebody. I said, interesting. Should I get married? I'm like, I'm going to look into that work because he's single with a house that's appreciated. She's the same way. I'm like, I don't know if that's really going to work.
Before you sell,
but I'm going to figure out.
You cash out before you sell, perhaps, but it really is about your basis. So if you bought the house for $600,000, there's some closing costs, there's some transaction costs. So maybe it's $605 or $610,
right? And
then you sell for $1 million. You've got some commissions, you've got some title policy, whatever costs, maybe 5, 6, 7%. So it might not be a full $400,000, but it's still going to be some number over $250 that's been subject to tax. So when my friend said this, I said that to me is brilliant. Like that could really free up some inventory out there. I mean, we don't have an inventory issue, but I think there's really good homes that aren't part of our inventory pool that are desirable.
Quality upper end homes. Yeah. I feel obligated to say this, not that it's really, germane to this conversation perhaps, but if you are selling investment properties and switching that and you're 1031ing it into different investment properties, be very, very mindful about how you go about navigating that. Just make sure from the get-go you are looping in a professional,
Yes.
somebody that can help you walk through that. An intermediary is what they're called, somebody who receives those funds, because on more than one occasion, I've dealt with folks who just, I thought I did all the right things.
They
I'm
winged it.
31 exchange.
Yeah, as soon as you take receipt of those funds, you are toast.
You're toast.
People just don't know about that.
No.
So.
Yeah, I've got a good 1031 guy locally here. Client of
Run it
ours.
through your own bank account.
Yeah, no, you never touch the money.
No, and there's some great title companies out there that have good resources for that too. I know one in Buda where we live. They do trainings on that every month. So there's some good resources out there.
Yeah.
So I got a personal question for you.
All right.
A lot of people don't grow up saying, I want to be a loan officer when I grow up.
Oh, man, love this.
And do people say, I want to grow up, be a financial advisor? Did you grow up that way? Or
No.
how did you get into this?
So my mom worked for a company called Northern Natural Gas in Omaha, Nebraska when I was born. That became Enron. And so we moved down to Houston in 1986.
Oh, wow.
And she was there she was there till 2008. So 7 years post bankruptcy. And so I saw all that go on. Thankfully, my dad was a little kind of savvier than the average bear. So my entire family's net worth wasn't tied up in Enron stock. And I mean, talk about tempting to not, because that thing would just scream to the top, split, and just do it over and over again.
Oh my gosh.
There's a fascinating movie called The Smartest Guys in the Room about that whole Enron deal. If you guys have never seen it, highly recommend it. So I saw that. My dad also had his own HVAC business for 20, 25 years. And so I saw life as a business owner from his perspective. And I kind of geeked out about all that. Was interesting to me, right? My parents were transparent about it, and that was great. And I went to Texas A&M, and I got a degree in history, right? Which obviously parlays itself into what I'm doing now super well.
Yeah.
But while I was there, I read things like Personal Finance for Dummies and The Wealthy Barber, which is a fantastic read for people who are just like, where do I start? What are the financial fundamentals? The Wealthy Barber is a great read. So I was learning things that I thought that everybody knew. And then I went to go work for Enterprise Rent-A-Car, because that's what happens when you get a liberal arts degree. You can work for Enterprise, or you sell insurance or whatever. And a new employee of mine told me, hey, I think these 401k things are a scam. I'm like, what the hell are you even talking about? I don't even know what you're talking about.
Wow.
And I thought he was and so it just blew my mind. And it was really at that moment that I kind of realized, okay, there's so much financial illiteracy that's out there. That stuck with me for a while. I moved up in Enterprise to where I was making some good money. My wife and I moved. We started tacking on kids, all those things. We got in over our skis, and we hired a financial advisor. And then they eventually said, hey, you should probably be doing this yourself. And that was 8 years ago.
Okay.
So that's, but, I don't think anybody geeks out and, grows up wanting to be do loans or financial planning or whatever the case may be. So, firemen and football players are kind of what it's like in my house.
It is interesting how we land into these financial roles. I mean, I was a marketing major, technically a business major, marketing major, but I'm really a finance. Like my mind, I'm a numbers guy. I've always really enjoyed the numbers side of anything. And my mom always said I should have been a CPA. Right, as a growing up, and so my uncle, has had a really good CPA practice for a long time. So it intrigued me, but it didn't. Like I wanted more interaction with my clients, and I wanted to problem solve with on a greater scope than just doing tax returns, right? But so much. The irony is, so much of what we do is with our clients' tax returns and trying to analyze, their income and qualify them and stuff. So some of those skills overlap a little bit. And then there's a lot of programs where we don't need tax returns. And so that's really part of what our mission is, Jeff and myself, this year is working with more business professionals and financial advisors and CPAs to educate about the different mortgage products out there so that you have, and you know enough to be dangerous already, but so you can let your clients know, hey, like you still may be able to qualify to buy a home, even though ... even though they don't have 20% to put down, or even though they don't have a adjusted gross income on their tax return that's some big number. Like there's ways to be a homeowner still.
Yeah, and what I want, my clients to understand, and everybody is, I take a super deep dive. I mean, I know a lot about my clients at the end of the day. And if one of their goals is to, I want to buy a house in the next, so on and, whatever the case may be, I just want to understand that and then pass it along, because it's not like it used to be.
Right.
We are not in this really black and white environment to where you got to have 20% down and all these ratios and all these different things like you were mentioning. It's just not that cut and dry. And so it's, okay, well, let's write that goal down and let's not let it go away.
Right.
And we're going to work on all these other things, but you're also going to have a conversation on the side with these guys too, because you guys have probably never written the same loan. Right. You've never done the exact same thing. And, that really speaks to the myriad of different options that are out there that people need. They owe it to themselves to investigate. But it goes back to what we were talking about earlier. I'm so overwhelmed. I don't know where to start. And if I go talk to somebody, I'm going to feel like an idiot. I'm going to feel, less than, whatever the case may be. But if you work with good people who are really people first, oriented and interested in developing relationships, man, all ships will rise.
Yeah, and maybe that's a little bit of a shift that I'm speculating here, but maybe a little bit of a shift that happened during COVID when we got away from a lot of personal interaction and things went to Zooms and things went to, just you got a lot more time on your hands and you're Googling stuff and going down a rabbit hole. And I think for some of our audience out there, right, that's the majority of the answers that they're seeking, they're looking for through Google or through a web search. And there's just no substitute for sitting down with a professional, and we talk about this all the time, like, don't disqualify yourself. Right. And what happens is, I think if you go down a rabbit hole on Google, all of a sudden, I don't think I can, this says this, so I don't fit into that. So it looks like I can't do what I want to do. Right. And all of a sudden you like pull yourself out of that optimism, being able to do it.
So I've been using ChatGPT since its inception, and it's funny how it's really, what people hate about it is that it's an echo chamber, right? It's an echo chamber of whatever websites it's cataloging and coming to their own evidence and conclusions. And if you challenge ChatGPT's evidence and conclusions, go, hey, like that number doesn't look like, can you double check it? It'll double check itself and go, oh, thank you so much for correcting me. Actually, further looking into it, I did find other resources. And so it's almost like a basic Google search has evolved into an echo chamber search. And there's a lot of those
wild
professional opinions that aren't making it to that web information. And that web information is really selling the wrong story when it comes to home ownership, when it comes to building a relationship with a financial advisor and diversifying your portfolio. And what we do, is combat this every day when we talk to people. Like our intake conversations, we're almost having to basically correct bad information every time.
Yeah, like, let's start dispelling the lies. Yeah.
And one of the things that JB and I love to do is when we're having those intake conversations, we're like, are you okay if we share this with your realtor and your financial advisor? Is this conversation okay for me to relay to your other people that are helping you in this process? Because if we can talk directly, like if we have a mutual client and we can talk directly to you about your mutual client, about like, hey, this product is available, but what is that going to do for them? Do they have 50% down? Do they have 10% down? Do they have 5% down? But we don't want to use all that. So having that direct line of communication where the people that know what the assets will do and the ramifications over the next 5 years for them will be is so much better, because then that client is really well taken care of when the line of communication is direct.
And imagine a relationship to where, it's not just like, hey, Jeff, I've got Mr. Smith. They're looking for something. Go ahead and work it. But, hey, why don't we sit down in this room? And, again, if you're doing things from a 360-degree perspective, right, from the financial planner perspective, I should really kind of be the GM of a lot of situations. Yeah. And, hey, we need to bring in this specialist. Let's go ahead and employ these guys. They know a lot. And for you guys, it's kind of project-based, right? But then I've got the CPA. It's like the CPA and the estate attorney. These guys are going to be part of our team for you forever. Yes. But I want a really solid bench of people that I know, like, and trust to bring in with folks. And, you don't have to have millions of dollars to have a team of good people around you. Something kind of going back to the web stuff, I think it's always important that people understand the bias of the professionals that they're getting the advice from, right? Because, gosh, I get calls from people, texts, whatever, and they say, I saw this thing on TikTok. So I was getting some advice on TikTok. They said that 401ks are a scam. I'm like, God dang. And so it's always like examine the bias.
Yeah.
What is this person's end goal? And unfortunately, it's how do you get compensated? And I think that's a totally fair question. I think it's a fair question to ask you guys. I think it's a fair question to ask me, and I love answering that question because until they know, they're kind of wondering through everything that you say. Is this guy saying that I should put less down so that he can write a bigger loan and then maybe he gets paid off the bottom line? And, so there's always those types of things. So if you kind of do an end around, and I think transparency is fantastic. So if I get the opportunity to tell those folks, and I think it's probably the same for all of us, right? There is no amount of compensation that we could get from one individual that's worth our reputation. And then secondly, I love working with people so that I can build advocates. I don't want to knock on doors. I don't want to cold call. I don't want to do those things. I want you guys to be my clients. I want to make transformational changes in your life and be like, man, I started working with Terry, game changer. You guys need to as well. Helped us get these rental properties, helped us do those types of things. And so I'm a big proponent of buyers of anything, really being discerning buyers and understanding, hey, when I'm going to build my team, I'm going to build a really good team.
Yeah, I love that. Well, and I think a lot of folks come, they're generally speaking, our clients are coming to us from their real estate agents most of the time. We have a blessed to have an amazing past client database. Thank you to all my amazing past clients and current clients and referral partners. And we've built these incredible real estate agent referral partners out there who a lot of times have the first conversation with the client. And I think as important as it is for us to have the financial team around us, our real estate agent partners need to also have that team. And I think a lot of times they're, at least what I've seen is, they got their home inspectors, they got their roofers, they got their plumbers, they got their electricians, because all those trades that need to happen to help a house close. And there's an opportunity there for our database, our sphere, and our real estate agent professionals to meet our financial partners as well, so that, well, first of all, they might need the help themselves, right? Because agents, real estate agents as self-employed individuals, that's a whole nother, that's maybe a SEP IRA and not a 401k that they're contributing to, right? And how can we help them maximize their tax advantages, and what kind of planning do they need? And a lot of our partners, real estate partners, want to buy their own house at some point, and they're building their business to then qualify. So how do we qualify? So we have this amazing kind of pool of professional resources that we can tap into. And a lot of times it's like our agents are working with the clients, and we have these incredible players on our team that work the finances, and we need to really build more relationship there,
I think that there's a lot of value in just what I've come to call like textual relationships too. It's like, hey, just because I call you, and I struggle with this. This is why I never go, this is why I don't deal with carnies at fairs, because as soon as I talk to them, I'm like, shit, man, I'm throwing the ball now. But it's like, I want to, it's nice to just be able to engage somebody and be like, hey, I'm not in your sales process. But know that when I need to be, I will be. But it's just really good that I can send out texts to people and understand. And I've got a lot of clients, and the extent of our relationship is, hey, my 401k offers a traditional and a Roth 401k. What should I do? I don't want people to be afraid of asking those types of questions of any of us, just because they're afraid of, committing to a much larger relationship, because I think all of us can meet our clients and our folks where they're at, right? Yeah, if they're just starting to figure out, hey, can I afford a house? Can you tell me what the heck these ratios are? You guys can answer that without then pestering them, because I think it's just so important that people become more informed in what it is they're doing, because that's where people end up getting hurt, is when they're not informed.
Yeah. One of our mantras that I say all the time on the show, I know you live by it, is the only way to make good information or good decisions is to be given good information, right? So it's like,
Good in, good out, right?
Yeah, and if we withhold good information from you, what are we doing?
Yeah.
Like, we're a bad human being, in my opinion.
Yeah.
So, yeah, I mean, our jobs as lenders, like, we don't get paid until you close.
Mm-hmm.
You know, and so, but we help people, like the majority of people we help and talk to, we never close their loans. Like it's a different path they've taken or something.
Mm-hmm.
And so we're talking to the majority of people we talk to, most likely we won't get paid by servicing them, but we still love it. And we're still going to do it because we're in the long game.
Yeah.
We're in the relationship game. And we do know that a better life is a better person out in the world. And so we're going to do everything we can to make better people.
Mm-hmm. And I mean, you know, honestly, I don't really ever believe in just pure altruism. I just don't think that's a thing, right? There's always something in it for you. Yeah. And what's in it for you in that situation is you taught somebody something, they see value in you, even though they didn't, you know, even though you didn't financially benefit from that transaction, they're a better person as a result of it. And they can
reputation.
Yeah, and they can say, man, you know, like I didn't end up going that route for whatever, but man, Jeff treated me like I was his best client. And what a cool feeling. I really value that. You need to go see him too. That's a great feeling.
Yeah. Yeah. And a lot of times it's a not now, however, here's the path.
Right.
Yeah.
And that's really important. Now, whether or not the path gets followed, right, and they end up buying a home, sometimes they don't, you're right. But gosh, there's been several times where we started working with the client and it's been 2 or 3 years in the making, and then they get the keys to that new house, and it's pretty fulfilling. I mean, that is really why we get up every day, right? To help our buyers achieve home ownership and or also help manage the asset that they've got through refinancing, through looking at their other things that are going on, you know, with our financial picture, debt consolidations, things like that. Because it is a financial tool. You know, mortgage is a financial tool, just like
a
lot
like
of
all the other stuff. Yep.
Well, I know we've talked about it a lot. I'm trying to think of how to wrap this up with you. So how do people get a hold of you if they're interested in, like, hey, it's my year. My year is...
I'm going to finally get it together.
I'm going to finally get myself together and get some advice. So how do they get a hold of you?
Well, like I said, my name is Terry Lee. I'm with the franchise of Ameriprise. And so if you'd like to get a hold of me, my email address is Terry, Lee, Lee, and that's at ampf.com. And like I've said, I mean, if it's just kind of one-off questions, or I can be a resource, or you're really finally able to paint the larger picture, I'd love the opportunity to help out in any way I can.
That's great.
Appreciate it. Yeah.
No,
sure appreciate it, guys. This is fun.
Appreciate you being on. Yeah. Anything else we want to touch on?
I think, you know, as we go through this, I've been listening a lot because I love what both you guys are saying, but I feel like these conversations have so many different directions we can go in. You know, I mean, we didn't even talk about investment.
We do this for 4 hours.
We could do this for a long time.
So you're welcome that we're not going to.
It's like one of multiple, you know, let's get financial advisor ideas going on, because I think as we start unpacking this, you know, a 30-minute episode could be a 4-hour episode.
Yep.
Yeah.
And I think that's what's tricky. And I always want to encourage people, you can talk directly to us, you know, if you're listening. So you can pick our brains, but we can, as you can start, like we started just geeking out from the bat. I mean, we just went right into the meat.
Yeah.
You know, because we love this stuff. So my joy in this is I see multiple episodes coming down the way.
I look forward to it, guys.
This one was like general, and I think we just get a little more specific as we go along.
Awesome. Let's do it. Appreciate it, guys. Thank you so much.
Thanks.
Yeah, absolutely.
Take care. See you next time.
And thanks so much for listening. Please like, subscribe, share to the Lending Podcast, and give us comments of what you want to hear from us. Thank you so much.
Take care. We'll see you soon.
Bye.